So these principles are also considered as norms or rules, which are usually followed by all the accountants in recording assets or whether it is liabilities, expenses, or incomes. And you might have heard about these two rules given as example here. Inventory stock is valued at lower of its cost or net realizable value. Cost means the money that has been paid to the supplier for purchasing the goods. And net realizable value means the market price minus the expenses that may be incurred in selling the goods. Net realizable value is quite different from market price. Sometimes market price may be considered as net realizable value if no other expenses is going to be incurred in selling them, or otherwise, to find out the net realizable value, you have to deduct expenses, expenses for delivery, expenses for advertisement, expenses for packing. So the net amount that you receive after deducting the expenses from the market price is known as net realizable value. Similarly, there is one another principle or rule that fixed assets should be depreciated over their expected useful life. You must have heard about depreciation. Depreciation, which means decrease in the value of an asset. And every year at the end of the year, while preparing balance sheet, we deduct depreciation from the fixed asset. To disclose this asset at its real value in the balance sheet, to ascertain the correct financial position at the end of each year. These are two examples which may be considered as rules, principles, or basis on the basis of which accounts are prepared, accounting is done. These principles can be classified into two categories. We may refer to this principle as accounting concept. We may call them accounting concepts, or we can also call them accounting conventions. So what are the accounting concepts? What is written over there in the screen? Accounting concepts are basic assumptions or fundamental propositions within which accounting operates. We can also understand these concepts as these are the generally accepted accounting rules on the basis of which transactions are recorded and financial statements are prepared. And it's very important that while passing entries, while recording the transactions, we follow these concepts. And unless we follow these concepts, if we don't follow these concepts, then user, the persons who are going to use the final accounts or financial statement, will not be able to understand them. The final account will be interpreted and understood by each and every person according to his requirement, if the concepts are not followed. Then second one, what is accounting convention? Concepts are rules. Then what are the accounting conventions? What is the difference? Accounting conventions, these are also rules, but these are developed over a period of time. These conventions are outcome of accounting practices. These rules, again, if we call them rules, these are not developed by any institute or by any accounting association. These are the practices which are being followed by accountants from a long period of time. So they also become, these regular practices also become rules. We can say that concepts are the written rules suggested by some associations, but conventions are the practices developed over a period of time by the accountants, and they are generally following. All the accountants are following those practices. So there is a minor difference between concept and conventions, written and unwritten. We can call them written rules and unwritten rules, developed out of practices only. So there, let's discuss now the features, some important points about these accounting principles. These accounting principles are man-made. Accounting principles are man-made, therefore they are the best possible suggestions based on practical experience. These are developed by accountants or the accounting associations. By their practical experience, they come to know about the difficulties being faced in recording, classifying. So they suggest a rule. And since the accountants associations are suggesting these rules, we can call them man-made. Accounting principles are man-made. Again, they are recommended for use by all enterprises. All the enterprises which are preparing their financial statement for outside users are required to follow these rules, principles uniformly, so that the financial statements are understandable to all the users, whether internal or external. So first feature is that accounting principles are man-made. The second one, these principles are flexible, not rigid. The rules can be changed according to our convenience, our necessity. You might have heard about the methods of providing depreciation. There are two methods of providing depreciation: written down value method and then straight line method. So suppose, for example, one accountant considers that straight line method of providing depreciation is suitable for him, for his enterprise. So he will follow a straight line method. There may be some other accountant who considers that written down value is the better method for his enterprise. So he will follow written down value method. So we can say that these principles are not rigid. You can adopt any of the alternative rules suggested in regard to a particular topic. Again, the second point says accounting principles are not permanent but change with time. These principles are amended time to time by the accounting association. In India, accounting concepts, principles are developed by the Institute of Chartered Accountants. And these principles, concepts are always revised from time to time. Over a period of 3 or 4 years, some requirement may be changed. And why do they change? Because the business environment is dynamic. It's changing every day. So requirement of accounting also changes along with the environment. We can take one another example also. Suppose government has passed some act and government requires that a particular item should be disclosed in your final account. But previously, in the accounting standard, there was no requirement about this. But since the rule has come into force, the government has passed a new act, we have to change. We have to amend the accounting standard. We have to amend the accounting principle or concept. So the second point says that, first point says that not rigid are flexible. And second point says that these are not permanent. They may undergo a change over a period of time. The third feature of these accounting principles are that they are generally accepted. They are accepted by everyone involved with accounting. So the first line says, accounting principles are the basis and guidelines for accounting and are generally accepted by everyone. And below that, the general acceptance of an accounting principle usually depends on how it meets three criteria. The first sentence says that these are accepted by everyone. And in the second sentence, it provides us the logic, the reason why all the accountants follow this principle. So there are three reasons. It is because of the relevancy of the accounting principle, because of the objectiveness and feasibility. If these three criteria, three reasons are met, three explanations are justified in regard to a particular principle or concept, then the accountants will definitely follow those concepts and principles. If these three criteria are not met, then the concept or principles will not be followed by the accountants. Let's see each one of them. What do we mean by relevance? The accounting concepts or principles are considered to be relevant if they result in information that is useful to the users of accounting information. Suppose there is a principle or concept which, if followed, won't be useful to the user of accounting information. Some accounting standard have been developed and it's of no use, it's useless. Then no accountant is going to follow them unless it is relevant. The second point, what is objectivity? Objectivity means that the principles are not influenced by the personal bias of the persons preparing the accounting information. It is not affected, influenced by the judgment of the accountant. It should be universal, should be understandable, should be comparable to everyone. Then only it will be considered as objective. The synonymous word of this objective is subjective. Subject means a person in accounting. If it is affected or influenced by the opinion of the accountant, then it is considered as subjective. So subjective principles may be different from person to person. Subjective principles are not followed by everyone. So the conclusion here is that the principles or concepts should be objective. Then the third reason, feasibility. Feasibility means that the principles are such that they can be applied without undue complexity. There is no complexity. It's easy. It's easy to understand and follow. And not much money or cost will be incurred if we try to follow them. That's known as feasibility of the principle. So the third feature of accounting principle is that they are generally accepted by everyone. And why these are accepted by everyone? Because they are relevant, objective, and feasible. So now let's go to the fundamental accounting assumptions or concepts. So what are concepts assumptions. Assumptions means the things that have been assumed while preparing the annual accounts of an enterprise. See the sentence here. Fundamental accounting assumptions or concept are the assumptions which are presumed to have been followed in preparation of financial statement or annual account. So you need not ask, suppose you are going through the financial statement of a company. So you need not ask about these assumptions to the accountant or the board of director, because these assumptions are considered as being presumed as being followed. Everyone does that. So you need not ask. And there are three kinds of such assumptions. But however, one important point, if any of the three assumptions are not followed, then that company or enterprise is required to disclose which assumption. We shall be discussing in a matter of few seconds those three assumptions. The point here is that if the assumptions, any of the three assumptions are not being followed, then it should be disclosed in the financial statement or final account as to which one of the assumptions are not being followed and why. The reasons for not following them. So we shall be discussing now the three fundamental accounting assumptions. If these are followed, then you need not disclose it. If these are not being followed, then you have to mention the name of the accounting assumptions which is not being followed and the reasons as to why this accounting assumption is not being followed. These fundamental accounting assumptions have been suggested by the Institute of Chartered Accounting in their first accounting standard. The three accounting assumptions that we are going to discuss about have been recognized as fundamental accounting assumption in accounting standard number 1, which states about disclosure of accounting policies. So we are going to discuss these three accounting assumptions which have been recognized by first accounting standard of the Institute of Chartered Accountant of India. The first accounting assumption is going concern assumptions. I have seen many questions about these assumptions in your past year's examination papers. Your exam is MCQ based. I tried to see the type of questions that are being asked in your examination, and there were so many questions based on this topic, on these concepts and conventions. So first assumption is going concern assumption. So what does it says? Going concern says that the business is going to continue its business in the foreseeable future, and there is no intention of closing down the business. There is no intention to close down the business or scale down its operations. This is first accounting assumption, going concern, that the business will be carried on for an indefinite period. And this assumption helps us in making in differentiating between the capital expenditure and revenue expenditure. Suppose you have purchased a machine. Example is given herein. A machine has been purchased for 1,10,000 and it's going to be used for 10 years. So it is not considered as an expense. It is not fully debited to the profit and loss account. It is depreciated year and year again at a fixed rate. And the total cost is spread over the entire life of the asset. And why do we do that? Because we know we are considering that our business will continue to exist, will continue to carry its operation in the coming 10 years. We are assuming that. We are assuming this fact. That's why we are writing just a portion, 1/10, 10% of the machine, cost of the machine in our profit loss on the debit side. So this is the first assumption, fundamental accounting assumption. You can connect it to the accounting of fixed asset. Next assumption is consistency assumption. Consistency means that accounting practices, principles are applied year after year in the same manner. The principles, the style of accounting, the treatment of a particular account is not changed year after year. Suppose a person is using a straight line method of depreciation in year 1, and then in the second year, he changes it to written down value. Then again in the third year, he switches to straight line method. So this thing is not allowed. This principle says that you can't change method of accounting, your accounting policy again and again. And the reason is that if you are changing again and again your method of accounting, that it won't remain comparable by the users of accounting. They won't be able to compare the financial statement of one year with another year, or the financial statement of one enterprise can't be compared with financial statement of another enterprise, because the consistency is not being followed. The method of treating a particular item is being changed over and over again. However, if it becomes necessary, then it can be changed. Consistency does not mean that you won't be able to change a particular method at all. You may change it. Look at the second sentence. This assumption says that the rule, the principle may be changed if the law or accounting standard requires it, or the change will result in more meaningful presentation. So there are three situations in which we can change the method of accounting in regard to a particular item. The first one is that if the law requires it, if the law changes, if the law of the land, law of the country changes, if the government requires it, that you should change your method, then you can change it. Another reason, that accounting standard requires it. Suppose the Institute of Chartered Accountant brings out a new accounting standard regarding the provision of depreciation, or regarding treatment of interest paid on long-term loan. then you have to follow it. You were following some other method, but now the accounting standard has been issued by the institute and it says that it is mandatory for all the accountant. Then you have to change your method, your earlier method. And the third reason is that if you consider that if you change the method, your financial statement will become more meaningful, will become more understandable to the users. Previously, they were not so. The previous method followed was not giving the correct profit, was not showing the correct financial position. In that case also you can change to correct the position. So there can be three areas, three regions where you may refuse to follow this assumption. One is if the law has changed, another is that the accounting standard has been issued, and the third one that it will result in more meaningful presentation of the financial statement. So this was the second fundamental accounting assumption. First one was going concern assumption, second one consistency, and the third one accrual assumption. Accrual assumption ask us to record the transaction when they are entered into. Suppose you have purchased a machine. You have not paid the money. The amount has not been exchanged. The machine has been purchased on credit basis and the amount will be paid after 2 or 3 months. So when are you going to record this transaction? On the date of purchase or on the date of payment? So this assumption says that the transactions should be recorded in your books of account when they are entered into. The transaction of the purchase of machine was entered into on the date of purchase. So it should be recorded, it should be journalized on that date itself and not when the amount is paid for that machine. So according to accrual assumption, a transaction is recorded in the books of account at the time when it is entered into and not when the settlement takes place. So this was the accrual assumption. In other words, we can say that revenue is to be recognized when it is realized, when sale is complete, when you have provided the services, then you get the right to demand the money from the customer. So record this transaction at that stage. The customer has not paid you the money. He will pay after 10 or 15 days. But since a right has been created or an obligation has come into existence, at that point of time, it should be recorded in the books of account. So these were three fundamental accounting assumptions. And the meaning feature, we discussed about meaning and features of accounting principles. In all, there are 14 principles, 14 concepts. These three are also these three things that we discussed: going concern, accrual, and consistency. These are also principles. But these concepts have some special position. These are considered as fundamental. And it means that you need not disclose in your financial statement whether you are following accrual, going concern, or consistency or not. If you are following that. But in case you are not following these three principles, then you need to disclose in your financial statement that accrual is not being followed, that going concern is not being followed, or the consistency. And you also have to disclose the reason for not following them. So this was the meaning, features, and three fundamental accounting assumptions that we discussed. There are 11 other concepts which we will discuss tomorrow. We will continue. This is an important topic. We will continue this chapter again tomorrow or day after tomorrow. Okay?
Okay, sir.
Okay, then good night. I need to start class for ITOs. ITOs candidates, you can disconnect yourself.